Live Iran-Israel war impact on currency markets today, including an intro for your channel, RV News, written in paragraph format and designed to captivate and inform your audience. Welcome back to RV News, the home of breaking updates, deep dive, financial reports, and everything you need to know about revaluations, global currency shifts, and economic turning points. If you're holding on to Iraqi Dinar, Vietnamese Dong, or simply tracking global markets, you've come to the right place. Today we're covering one of the most urgent and globally impactful stories in recent memory, the escalation of the Iran-Israel conflict and its direct effect on currency markets around the world. Stay with us as we go deep into what's happening right now, why it matters for global currencies like the US dollar, the euro, the Iranian Rial, the Israeli Shekel, and more, and what this war could signal for the future of revaluations and the global financial reset. As tensions flare in the Middle East, global investors and central banks are watching nervously. The conflict between Iran and Israel, which has moved from shadow warfare and cyber attacks into direct military engagement, is already rattling major financial institutions. Overnight, markets began showing signs of instability and currency. Traders quickly began repositioning their portfolios. The Iranian Rial, which has long suffered under international sanctions and internal inflation, took another dramatic hit in offshore markets. Meanwhile, the Israeli Shekel, normally seen as relatively stable due to Israel's robust economy and tech sector, experienced sudden drops in value, reflecting geopolitical uncertainty and investor concern about the war's long-term implications. In the times of war, especially in regions as geopolitically sensitive as the Middle East, currency markets become highly volatile. That's exactly what we're seeing today. The US dollar initially saw gains as investors fled to safety, which is a common pattern. In moments of conflict, particularly when oil-rich nations like Iran are involved, the greenback is typically seen as a safe haven. Gold surged as well, another traditional safe asset, while risk currencies such as the euro and the British pound saw minor pullbacks. What's interesting here is how emerging markets reacted. The Turkish lira, already under pressure from years of inflation and unconventional monetary policy, continued its downward slide, while the Iraqi dinar showed signs of speculative interest from foreign buyers hoping for long-term gains in post-conflict reconstruction scenarios. But let's focus on Iran for a moment. The Iranian Rial is extremely sensitive to geopolitical events. Before this war broke out into the open, it was already under significant strain from years of sanctions, economic mismanagement, and political unrest. Today, the Rial dropped over 8% in unofficial markets, with some traders in Dubai reporting that it has become nearly untradeable. The Central Bank of Iran has tried to intervene, pledging support and calling for calm, but history tells us that these efforts are often short-lived when military action escalates. For Iranian citizens, this means skyrocketing import prices, a collapse in consumer confidence, and increased economic pain. For currency traders, it raises the question, is the Rial even a viable investment or trade in the near term? Switching to Israel, the shekel has long been a strong performer, bolstered by Israel's tech-driven GDP and diversified economy. However, as of today, Israel's central bank has begun intervening in currency markets, spending billions of dollars in foreign reserves to try and prop up the shekel. The exchange rate jumped to over 4 shekels per USD, its weakest level since 2020, amid reports of missile strikes near Tel Aviv and heightened military mobilization. Investors are deeply concerned not just about immediate physical damage, but also about long-term economic disruptions, foreign investment slowdown, tourism collapse, and possible credit rating downgrades. That has led to a wave of capital outflows, and unless the conflict de-escalates soon, we could see the shekel continue to fall, despite central bank efforts. The broader regional impact is also worth noting. In Iraq, the government has urged calm and neutrality, fearing that an expanded war could spill into its territory. The Iraqi dinar has remained relatively stable on paper, due in part to the Central Bank of Iraq's managed exchange rate policy. However, behind the scenes, currency brokers are reporting increased inquiries from foreign buyers. This is especially true among those who believe the dinar will appreciate in the future as Iraq rebuilds and benefits from higher oil revenues. Still, with Iran as a close neighbor and Iraq's borders always vulnerable to regional instability, any further escalation could put pressure on the dinar, both in perception and in real economic terms. Another key element is oil, with Iran And Israel at war, fears of a broader Middle East conflict are pushing crude oil prices sharply higher. Brent crude surged past $100 per barrel for the first time in over a year, while West Texas Intermediate followed suit. This price spike has major implications for energy-importing nations like Japan, India, and many European countries whose currencies are sensitive to oil costs. The Japanese yen weakened further as a result, while the Indian rupee dipped in early. Trading, on the flip side, oil-exporting countries like Saudi Arabia, Kuwait, and Iraq may temporarily benefit from higher revenues. However, those benefits could be short-lived if supply chains are disrupted or if the conflict leads to direct attacks on oil infrastructure, as has happened in past Middle Eastern wars. Looking westward, the euro is showing mild weakness as European economies brace for the potential fallout. Analysts fear a resurgence in refugee flows, supply chain disruptions, and higher energy prices that could stifle the fragile economic recovery across the continent. The European Central Bank has so far remained quiet, but a prolonged conflict could force them to reconsider interest rate cuts or additional stimulus. In such an environment, the euro could continue to slide, especially if the war spreads to involve Lebanon, Syria, or even Gulf states. In contrast, the Swiss franc, often seen as a European safe haven, strengthened today, reflecting a flight to stability. Turning to the United States, the dollar is gaining ground, but the situation is complex. While a strong dollar can reflect confidence and safety, it also poses risks for American exports and can increase pressure on developing economies that borrow in USD. The Federal Reserve now faces a unique challenge: inflationary pressures from rising oil prices on one hand and the potential deflationary risk of a global slowdown on the other. Wall Street opened lower today with the Dow, Nasdaq, and S&P 500 all in the red, signaling broader economic anxiety. If the war continues or worsens, we could see the Fed pivot toward a more dovish stance to support growth, which in turn might cool off the dollar's rally. Currency strategists are already adjusting their forecasts. Goldman Sachs revised its three-month outlook on the shekel, predicting a 10% further drop if the conflict escalates. JP Morgan has placed the Iranian Rial in a no-trade zone due to sanctions and war risk, and Credit Suisse has recommended clients reduce exposure to emerging market currencies, especially those in the Middle East and North Africa. Meanwhile, some hedge funds are increasing their positions in gold and digital assets, seeing them as hedges against fiat volatility. Bitcoin and Ethereum both saw sharp increases today, rising over 7% in a single trading session, a clear sign that alternative stores of value are gaining traction in times of crisis. Let's talk briefly about China and Russia. Both nations have responded cautiously to the conflict, calling for restraint while quietly evaluating their economic opportunities. The Chinese yuan is holding steady, in part due to tight government control, but Beijing is concerned about energy costs and global supply chain disruptions. Russia, meanwhile, stands to benefit economically from higher oil prices, which could give the ruble a short-term boost. However, Moscow is also wary of increased Western involvement in the Middle East, which could complicate its own interests in Syria and the broader region. If Russia uses the chaos as a cover to expand influence, currency markets could see further jolts as new alliances shift financial flows. From the revaluation perspective, this war could either delay or accelerate certain moves. On one hand, global instability and military conflict generally delay financial reforms and currency revaluations because governments become preoccupied with defense spending and political survival. On the other hand, the war could act as a catalyst for a broader reset as the current system struggles to adapt to new geopolitical realities. If the IMF, World Bank, or key global powers decide that a new financial architecture is needed to manage post-conflict recovery, we could see accelerated moves toward asset-backed currencies, new SDR baskets, or bilateral revaluation agreements. For holders of the Iraqi dinar or Vietnamese dong, the big question remains: does this chaos delay the RV or bring it closer? The truth is, it depends on how long the war lasts and how wide it spreads. If the conflict remains regional and is resolved quickly, countries like Iraq may actually benefit in the short term from oil revenues and increased strategic importance. However, if the war drags on or expands, economic uncertainty could delay any major financial resets, especially those that rely on global coordination. That said, the increased attention on currency systems,